Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Nebius Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really does help us keep the lights on and the data flowing.
It absolutely does. And today is a big one. We're unpacking a company that's sitting right at this, chaotic intersection of massive hype and absolutely critical infrastructure.
We're talking about Nebius Group.
We are.
This is one of those names that just keeps popping up on the biggest movers lists. I mean, the stock gained over 200% in 2025.
Yeah.
That is the kind of chart that makes you just stop scrolling. But then, you look at the valuation and you have to ask, is this the real deal? Or is this just another AI bubble looking for a pin?
Well, that's the classic growth investor's dilemma, isn't it?
Yeah.
But to understand Nebius, you have to realize they aren't just another generic cloud provider.
Right.
They're not trying to be Amazon AWS or Microsoft Azure, selling storage for your family photos. They call themselves a neocloud.
Neocloud. Okay, that sounds cool. Almost sci-fi, but let's unpack that. What does that actually mean for the business?
Think of it like this. The traditional cloud giants are like a massive supermarket. They sell everything to everyone.
Okay.
A neocloud like Nebius. It's more like a specialized high-performance factory. They are the pure picks and shovels play for the absolute cutting edge of this AI infrastructure boom. They are capitalizing on a huge supply-demand imbalance.
An imbalance where the biggest companies in the world are, just starving for computing power?
Really starving for it.
Okay, so they're selling water in a drought. But let's talk about the price tag on that water. The stock's had a huge run. Expectations are through the roof. So let's get into the numbers.
Let's do it. The fundamentals.
Right. The report for Q3 2025, the growth is undeniably there. Annualized revenue was, $146 million?
And that's up 355% year over year.
Which is huge.
Right.
And for the first 9 months of 2025 combined, total revenue was $302 million.
Those percentages are impressive, sure. But here is where we hit what I call the hypergrowth inflection. It's not about what they did yesterday. It's about what management is saying they're going to do tomorrow.
Okay.
Their guidance.
Yeah.
It isn't just growing, it is exploding. They're projecting annual recurring revenue ARR of $7 to $9 billion by December 2026.
Hold on. Let's pause there for a second because that number is staggering.
It is.
You're saying they're going from an estimate of, $550 million in 2025 to nearly $9 billion in ARR in 1 year.
In 1 year.
That's not a curve. That's a vertical line. How is that even credible?
You make it credible by looking at the backlog. That is the key differentiator here. This isn't some speculative, hopeful demand.
Right.
This growth is backed by a $20 billion contract backlog they've already signed on the dotted line.
Okay, $20 billion in backlog. That definitely helps. But
Yeah.
who are these contracts with? Are we talking about startups that might run out of cash?
No. The biggest players, the hyperscalers. We're talking multi-year deals with Microsoft, worth over $19 billion.
$19 billion from Microsoft alone.
And another $3 billion deal with Meta. They need this capacity, and they needed it yesterday.
So Microsoft and Meta are basically underwriting this entire expansion. That does change the risk profile significantly. But why Nebius? Why not just build it themselves or go to Amazon? What's the moat?
It's that neo-cloud advantage. See, Nebius is an NVIDIA cloud partner. That gives them early access to the absolute best hardware, the Rubin and Vera Rubin NVL72 systems.
The top-of-the-line stuff.
Exactly. Plus, their infrastructure is designed specifically for these AI workloads, not old legacy stuff. And this is key. They have a 20% power efficiency advantage over their peers.
Power efficiency. I feel like that's something people overlook, but in a world where every data center is fighting for grid access, that sounds like a very big deal.
It's huge. Power is the limiting factor. That 20% is pure margin. If you can run the same job for 20% less electricity, you win.
And I've seen some of the data from Goldman Sachs on this. They're expecting a 9 gigawatt data center supply shortage in 2026?
Exactly. It is a seller's market, plain and simple. Nebius has sold out capacity. If you have GPUs and power right now, you can basically name your price.
Which explains the incredible revenue jump.
It's why it's credible. They have the supply in a market with a desperate shortage.
But we have to talk about the bottom line. They are still losing money, right?
Currently, yes.
Yeah.
In Q3, they posted a net loss of $120 million. Building these things is expensive. But, and this is the critical part, look at the trajectory.
Okay.
Adjusted EBITDA is projected to turn positive this year in 2026. And by 2027, they're projecting it to exceed $5 billion.
From cash burn to cash cow in about 24 months. That's
Okay.
the bet.
Okay, so that's the fundamental story. Let's pivot to the charts. What's the price action telling us?
Well, the momentum is clearly bullish. Year to date in 2026, the stock's up roughly 28%.
So a very strong start to the year. Investors are still buying in. They are. And structurally, it looks good. It's holding above the key moving averages. The 50-day is sitting around $93. The 200 days down around 87, 88 bucks.
So as long as it stays above those levels, the trend is intact.
Right. And for a bit of context, just look at the long-term performance. If you'd invested $100 10 years ago, it'd be worth nearly $780 today.
That's some serious compound growth. But we have to talk about the volatility.
Oh, yeah?
This is not a stock for the faint of heart. The beta is 4.0.
It's a high flyer.
It means if the market moves 1%, Nebius tends to move 4%. We just saw that on January 20th. The whole AI sector took a hit, and Nebius dropped, what, 8.7% in one day?
It did. But that pullback, it actually brings the price right down to a key breakout level. For a contrarian buyer or someone who missed that initial run, this dip kind of looks like an accumulation zone.
So a potential entry point.
Potentially. The fundamental story didn't change because of one red day.
And there's another technical catalyst sort of lurking here, isn't there?
Yeah.
The short interest.
Oh, absolutely. The short interest has crept up to about 15.5% of the float.
That's, what is it, 33 million shares sold short?
Roughly, yeah. And with the average daily volume, that gives you about 2.7 days to cover.
Which is right in that squeeze zone.
It's a powder keg waiting for a match. If we get any kind of positive catalyst, like an earnings beat, those shorts could be forced to cover all at once.
Creating a huge wave of forced buying.
On top of the organic demand, yeah.
Okay, so checking the market perception.
Yeah.
What's the sentiment out there? Are people terrified of this valuation, or are they chasing the growth?
According to the Alta Vantage data, it's surprisingly bullish.
Mm.
The weighted sentiment scores are averaging between 0.33 and 0.40.
Which means?
Basically, 8 out of 9 recent major articles are relevant, and they're mostly bullish.
That makes sense given the headlines. It's tough to write a bearish article when a company announces a $19 billion deal with Microsoft.
Those are what we call hard catalysts. You can't argue with them.
It's not a projection, it's a fact.
Exactly. The execution of the Microsoft and Meta deals, the NVIDIA partnership, these are solid facts driving the optimism.
Yeah.
But you do see some red flag headlines popping up.
Usually about insider selling.
Yep.
Right, I saw that. Executives like Kira Rudinsky and Arkady Veloz selling shares in early January. You see insiders dumping stock after a huge run-up, and it makes you nervous.
It's the first thing you check. Are they cashing out at the top?
So are they?
You have to look at the context. These are mostly sell-to-cover transactions.
Explain that for anyone who might not know the term.
Sure. So when an executive gets stock-based compensation, they owe taxes on it right away. So they often automatically sell a portion of those shares just to cover the tax bill.
Okay.
Rudinsky, for instance, only sold about $33,000 worth of stock.
In the grand scheme of things, that's nothing.
It's noise. It's not a lack of confidence. It's just tax planning.
Okay, so we can probably set the insider selling aside for now. What about the big money? The institutions?
That's where you see the real conviction. We saw Fred Alger Management adding Nebius to their small-cap focus fund.
That's a strong signal.
It is. Active managers like that, they don't buy into a bubble. They buy into growth they believe is sustainable.
So the smart money is buying, insiders are just paying taxes. That's a pretty good setup. But we have to look at the risks.
You have to.
You can't ignore the bear case here.
No, and there are some very real ones that every investor needs to be aware of.
The elephant in the room is the valuation, that price-to-sales ratio.
60 to 64 times trailing sales.
It's a massive premium. The NASDAQ average is somewhere between, 5 and 9 times sales. Nebius is priced for absolute perfection.
It is. It's priced as if all that future growth is already guaranteed.
And achieving that growth means building massive infrastructure. Which brings us to the CapEx problem. This stuff isn't cheap.
It's incredibly capital intensive. It costs about $10 billion to build 1 gigawatt of data center capacity.
And then you still have to fill it with chips.
Exactly. That's another $20 to $30 billion just for the GPUs.
So do they have the cash?
Well, they have about $4.8 billion in cash. But they also have $4.6 billion in debt. So net cash is almost flat.
That math doesn't quite add up if they need to spend 30 or 40 billion.
It doesn't. And that's the dilution risk. They are going to need to raise more capital.
Equity or debt?
One or the other, or both. They need cash to build the infrastructure to fulfill that Microsoft contract. We can easily see a 10, maybe 20% dilution of current shareholders.
So if you hold the stock, you might own a smaller piece of the pie in a year.
Yes. But the bull argument is that the pie will be 10 times bigger, so you won't really care.
Fair point.
Yeah.
But there's also just pure execution risk. Can they physically do it?
That's the billion-dollar question.
Deploying a gigawatt of capacity by the end of 2026 is a logistical nightmare. Construction delays, power permits, supply chain issues with NVIDIA.
Any delay means they miss their revenue targets.
And with this 64 times sales multiple, a delay is a disaster. That stock could get crushed.
That is the cliff edge walk you are taking here. If NVIDIA ships 2 months late, the whole thesis is in jeopardy for a while.
So weighing that massive backlog against the massive valuation and the execution risk,
Yeah.
what's the verdict? How do we score this?
I'm giving Nebius a bullish score of 8.2 out of 10.
That's pretty high given the risks we just laid out.
It is. But you have to look at this rare hyper-growth opportunity. If, and it's a big if they hit that $7 to $9 billion ARR target, the valuation compresses so fast.
Right.
We're not looking at 60 times sales anymore. We're dropping to maybe 6 or 7 times sales on a forward basis. And that brings it right in line with the market.
So the stock price could stay flat, and the valuation would suddenly look cheap just because the revenue finally catches up.
Exactly. Or the stock price doubles, and the valuation still looks pretty reasonable. That $20 billion backlog, it provides a safety net that most growth stocks just don't have.
And the supply deficit gives them pricing power.
They can charge premium rates because there's literally nowhere else for these big companies to go.
So what should we be watching for? What's the next big trigger?
All eyes are on the Q4 earnings. That should be late January, early February. We need to see them confirm the guidance. If they reiterate that 2026 ARR target, the thesis holds.
And what about price targets?
The consensus is sitting around $155. That's about 44% upside from here.
Okay.
But if the execution is flawless, the bull case goes all the way up to $276.
That is a massive range.
It just reflects the volatility, It's a high-risk, high-reward play.
It certainly sounds like it. So my final take is this. It's a really compelling story, but it is for a multi-year hold, not a quick trade. You have to be willing to stomach extreme volatility. If you can't handle a 20% drop in a week, you should not be in this name.
I agree.
But if you believe in the AI infrastructure build-out, this is one of the purest plays out there.
It goes back to that old saying about gold rushes, right? Don't dig for gold, sell the shovels. In this AI gold rush, Nebius is selling the shovels, the pickaxes, and all the heavy machinery.
And charging a huge premium for it.
Precisely. Maybe one final thought to leave you with. Think about data gravity.
Go on.
Once Microsoft and Meta move these massive workloads onto the Nebius cloud, the cost of switching away becomes incredibly high. They're not just renting servers, they're integrating into an entire ecosystem.
That stickiness.
That stickiness might be the most undervalued part of this whole story. The shortage gets them in the door, but the gravity keeps them there for a decade.
A sticky, high-margin future. We will see if they can build it fast enough.
They certainly will.
If you found our talk useful, please consider subscribe, like, and comment underneath. It helps us a ton.
Until the next market update.
Thanks for listening.